All right, well, joining me now to break down everything that we need to know when it comes to markets is Vance Howard. He's CEO of Howard Capital Management. Vance, it's great to have you on the show this morning.
How are you?
I'm well, thank you. And of course, investors feeling optimistic this morning. What are you watching in the markets?
Well, there's a lot to be watched in the market. The CPI came out a little bit better than what we'd anticipated. Yesterday's PPI came out a little bit better than what we'd anticipated. But on the short-term basis, we're a little bit negative because I think we're going to get somewhat of a pullback and a sell-off. I think the market needs to work off some froth. And you started seeing the market roll over about the first week of December, and you've seen it kind of continue on that trajectory. You know, the NASDAQ's been down 5 days in a row, so to have an updated day is not to be unexpected if you've got some shorters covering their positions and maybe a little bit of optimism out there. I still think we need to work down a little bit lower to work off some of what was built up in the last quarter of last year, and I think we'll start to see that now. Wouldn't surprise me if we dropped down and retested 5,700 on the S&P.
And do you see that as a consolidation or a correction?
I think it may be a little bit of both, to be quite candid. We've been a year and a half without a 10% correction, and that's an unusually long period of time not to have a good solid 10 to 12% pullback. So we're due, and it's going to happen. We're just, we just don't know when.
Yeah, I think it's worth noting, right, that many participants who watch the market say that even a correction can be healthy at times, given how far we have seen the market rise in the first 2 years of this bull market.
Corrections are absolutely necessary. You have to have them to move forward. You're going to have periods of consolidation. People are moving their book around. They're taking profits off some equities that they've made good money in. You've got to have them to move forward. So they're going to happen. So just get used to them. But what you want to try to do is try to sidestep the ones that are dramatically overbought and try to peel some off of there and take some profits and move it to other areas of the market that you can actually pick up some decent gains when the market turns back up.
Yeah, let's talk about these bank earnings. Investors optimistic in the wake of better than expected results, certainly from big banks like JP Morgan Chase and Citigroup. Strong trading results specifically at play there. What's your view on the banks?
We were talking about that a minute ago, and we came into 2025 very, very positive on the banks, very bullish, and I wrote about it in the Wealth Watch, which I write. Over the past week, we're taking a step back, and let me tell you why. This event in California is going to impact impact banks more than people are factoring in this morning. Because you look at Wells Fargo, you look at Bank of America, they've got a large holding in mortgages. Well, if you've got a $20 million house and you've got an $18 million mortgage and it just got burned to the ground, you've only got $3 million in insurance. Some of these people are going to walk away from $10, $15 million loans out there. And that wasn't just houses that burned down. We're talking strip centers. We're talking, multifamily. We're talking, some high-rise buildings out there. It was a lot. And you look at the regional banks, too. We were bullish on the regional banks going into 2025, but we're going to peel back and take a good look at that and see how this is going to affect the regional banks, especially the ones that are really concentrated in California. Because we saw two that failed, a couple of years back, a year and a half ago. How's this going to impact them? This is a big deal. It's a lot bigger deal than I think people are factoring in is what's going to happen in the coming second and third quarter of this year.
We've been watching the wildfires, and of course our hearts are with everyone who was affected in that Los Angeles area indeed. So as earnings season continues, of course, other sectors will start to report. Technology very much in focus has driven a lot of the market gains that we saw, at least for the first 2 years of the bull market. The tech sector, the largest sector, of more than 20% weighting in the S&P 500. How does that sector expect to perform?
I think it's going to do very, very well. We've always had this build-up in AI, but just kind of getting long in the tooth on AI. We need to see something really happen with AI where we can actually visually say, okay, this really impacted this company and made it, much, much better or improved their earnings per share. Like one of our top picks is Salesforce. Now, I think that's one that can really benefit from AI where you can actually see how it's affecting you as far as marketing, because it's an internet marketing type of a system. Plus, it's got recurring revenue, which we like. I think tech's going to do just fine this year. You can't hardly not have it in your portfolio. Let's face it, that's one of the most interesting, sectors of the market. It's like I tell people all the time, Procter & Gamble's a great company, has a pretty decent dividend, but are they really going to make the most interesting bar of soap next year?
So how much of the tech momentum has to do with artificial intelligence investments that these companies are making in that technology?
I think a lot. I think it's a big impact of why people are buying it. You look at the price to earnings and they're a little bit elevated. Well, the reason they're elevated is because they're betting on what's going to come next, a year out, 2 years, 3 years, which is prudent. That's smart. That's what you're trying to game. But how much it's going to impact the earnings, we'll have to wait and see. But again, we're very bullish on tech.
In just about a week's time, less than that, just 5 days or so, we will see the inauguration of President-elect Donald Trump. Does your portfolio positioning change with the new administration, with new goals coming in?
To some degree, yes, because if they take off a lot of regulation, that's going to take off not only from large companies, mid companies, but also the mom and pops, the 1, 2, 3 person, plumbing company out there, and that's going to make an impact on them being able to have additional income inside of their coffers too that they can spend as far as the retail and spending is going, which will increase the value of the market also. But yeah, I think it's going to be net a positive. Doge, I think, is really interesting. If they can actually reduce some of the overhead that we have in the federal government, that's going to be an impact too.
Vance Howard, CEO of Howard Capital Management. Vance, thank you so much for joining in person.
Yeah.